Your grandfather kept gold coins hidden in a safe. Your nephew has his savings in a digital wallet on his phone. One of them is holding real wealth. The other is holding an illusion. The question is, which one?
Welcome back to Daily New History.
Today, we are tackling perhaps the single biggest question in finance right now. I'm taking the position that despite the current price action, Bitcoin remains a superior form of money for the digital age. And this divergence is actually a massive buying opportunity caused by, well, a misunderstood liquidity event.
And I'm taking the position that gold is the only proven store of value when the chips are down. The last few weeks have been a stress test for the entire global financial system, and frankly, Bitcoin failed that test while gold passed with flying colors.
Okay, so let's get right into the positions. I want to start by addressing the elephant in the room, which is the price action we're seeing right now in early 2026. It's easy to look at a snapshot of January, gold up 18%, Bitcoin down, and declare the digital gold narrative dead. But that is incredibly short-sighted. If we zoom out just a little bit, looking at the last decade from, say, 2016 to 2026, Bitcoin's cumulative return is over 20,000%. Gold's return in that same period, about 300%.
Sure, if you bought 10 years ago, but most people didn't buy 10 years ago. They bought last year or last month.
But that asymmetry is the point. We are witnessing the monetization of a completely new asset class. Bitcoin represents a new financial rail. It's portable, divisible, and censorship-resistant in a way that, physical metal simply cannot be. What we're seeing now, this correlation with tech stocks, it's just a temporary phase of maturation. The institutional adoption we've seen with BlackRock and Fidelity ETFs holding billions, that validates the asset. Writing it off because it didn't spike the moment a geopolitical crisis hit, it's missing the forest for the trees.
I see why you rely on the 10-year growth chart, because it's the strongest card you have. But store of value does not mean get rich quick. It means reliability when the world is burning. My position is rooted in the reality of what's happening right now. Investors are scared. We have the U.S. threatening, 10 to 25% tariffs on European nations. We have a diplomatic standoff over Arctic resources. In that environment, capital isn't flowing into the new financial rail. It's fleeing it.
It's fleeing to liquidity.
It's fleeing to safety. Gold is acting like a shield. It has sovereign neutrality. It doesn't rely on the internet grid or a private key. It is the ultimate insurance against system failure. And look, we're seeing central banks, China, Poland, Brazil, buying gold at record paces. They aren't stacking Satoshis in their reserves. They're stacking pars. That tells you everything you need to know about what pristine collateral really looks like.
I think that brings us perfectly into our first core area of debate, the safe haven test. You mentioned the Greenland crisis and the tariff threats. It's true. In the immediate shock of January 19th through the 23rd, we saw gold spike and Bitcoin sell off alongside equities. But I would frame this differently. You're looking at a liquidity cascade.
Explain that, because to the average listener, liquidity cascade sounds like a very fancy way of saying everyone sold because they were panicked.
It's mechanics, not just panic. Bitcoin is the only asset class that trades 24/7, 365. It never closes. So when a shock hits the system, like the news-outing nuke, traditional markets might be closed or circuit breakers halt trading. Hedge funds and institutions, they get margin calls on their illiquid positions. They need cash immediately. So what do they sell? They sell what they can sell. And Bitcoin is the most liquid, accessible ATM in the global casino. It gets sold off first to cover losses elsewhere. That isn't a failure of the asset. It's a feature of its liquidity profile.
That is a very convenient explanation. It crashed because it's so useful. I'm not convinced. Look at the data. For years, the marketing pitch was Bitcoin is uncorrelated. It was supposed to be the asset you hold when the stock market crashes. Now the data shows a correlation with tech stocks of nearly 0.8. It behaves like a leveraged bet on the NASDAQ, not a safe haven. If I'm an investor looking to protect my purchasing power during a trade war, why would I buy an asset that drops 30% when the news breaks?
Because you're confusing volatility with risk. Gold is stable, yes, it has that 10 to 15% annual volatility profile. Bitcoin is volatile, but that volatility is the price you pay for the performance I mentioned earlier. And let's look at the risk-on versus risk-off labels.
You say it's behaving like a risk-on asset. I say it's behaving like an asset in price discovery. The market is still trying to figure out how to value a decentralized monetary network.
The market seems to have figured it out pretty well this month. It valued it 30% lower. Look at the behavior of silver right now. It's up 22% recently. The entire precious metals complex is surging because it is a risk-off environment. Bitcoin is behaving like a risk-on asset. It's a spear, not a shield. And when you are trying to preserve wealth, you want the shield.
I think we need to distinguish between the immediate market reaction and the fundamental properties of the asset, which leads to the second theme, scarcity. You talk about gold being the ultimate money, but let's look at the supply. Gold supply increases by about 1.5% to 2% every single year through mining. It is elastic.
Elastic how? It can take 10 years to permit a new mine.
But if the price goes to $10,000 an ounce, which is possible given the current climate, we will find more gold. Economics dictates it. We'll mine the ocean floor, we will mine deeper veins. The supply response to price is slow, but it's real. Bitcoin breaks that rule. The supply is mathematically capped at 21 million. No matter how high the price goes, you cannot create more Bitcoin. In fact, the inflation rate drops every 4 years. We're in a period now where Bitcoin's inflation rate is structurally lower than gold's. In a world of infinite fiat printing, absolute scarcity is the ultimate value proposition. This is the stock-to-flow model playing out.
I agree that the 21 million cap is a brilliant piece of engineering, but scarcity alone doesn't create value. Demand does. My issue with the mathematical scarcity argument is that it relies on the protocol never changing and the network always existing. Gold scarcity is geological. It's physical. It doesn't rely on a server farm in Texas or a mining pool in Asia. And let's talk about that physical nature. You can verify gold with a simple chemical test. It doesn't require electricity. It's atomic number 79. You can't hack an atom.
But try moving those atoms. If you need to flee a jurisdiction, and given the geopolitical climate, that's not a zero probability event, try crossing a border with $1 million in gold bars. It's heavy, it sets off metal detectors, it gets confiscated. I can cross any border in the world with $1 billion in Bitcoin stored in my head as a seed phrase. That is a level of property rights that gold just cannot compete with. It is unseizable if custodied correctly.
That portability is a fair point, I'll grant you that. But it cuts both ways. You can lose that $1 billion in your head if you forget the phrase or if you get hacked. Gold is hard to move, sure, but it's also hard to hack. And regarding the central banks, you kind of glossed over this earlier. Why do you think central banks, the most sophisticated financial entities in the world, hold 50,000 tons of gold and almost zero Bitcoin?
Because they are slow, conservative institutions designed to preserve the status quo. They operate on decades, not years. But even that is changing. Look at Basel III regulations. Gold was reclassified as a Tier 1 asset. That was a specific regulatory shift to strengthen bank balance sheets. But look at what's happening in the private sector. We are seeing the dawn of the institutional era for Bitcoin. Look at the success of the spot ETFs. BlackRock's IBIT is managing billions. We have major corporate treasuries like MicroStrategy holding huge reserves. We have the US passing the Genius Act and the EU with MiCA. Bitcoin is being integrated into the regulated financial system. It's no longer just cypherpunks, it's Wall Street.
Wall Street will sell whatever people want to buy. The fact that BlackRock collects fees on a Bitcoin ETF doesn't mean they think it's better than gold. It just means they know there's demand for the product. But look at the sovereign level. Outside of El Salvador, which is a very specific case, reserves are gold. Gold is outside money that doesn't depend on the US financial system. Bitcoin, ironically, has become highly correlated with US liquidity. If the Fed tightens, Bitcoin drops. Gold has proven recently it can rally even when rates are high, purely on geopolitical fear. That is true independence.
I'd argue Bitcoin is the only asset that is truly independent of any state. Gold reserves can be seized or sanctioned if they're held in foreign vaults. You can ask Russia about that. Bitcoin on a decentralized ledger is unseizable. But I want to pivot to the risks because you mentioned hacking. What about the physical risks of gold, specifically the environmental costs of getting it out of the ground?
Well, let's talk about the environment. Bitcoin mining uses as much energy as medium-sized nations like Argentina. In a world increasingly focused on ESG, that is a massive headwind for institutional adoption.
That's a narrative that really needs updating. Bitcoin mining is increasingly the buyer of last resort for stranded energy. It's stabilizing grids in places like Texas by shutting down during peak demand. But more importantly, look at methane venting. Miners are setting up on oil fields in North Dakota, taking methane gas that would otherwise be flared or vented directly into the atmosphere and combusting it to generate electricity for mining. They are actively reducing carbon equivalents.
Some are, not all.
A significant portion. Now compare that to gold. Cyanide leaching, mercury pollution, massive open pit destruction. Gold mining requires moving tons of earth to find a few grams of metal. It's an ecological disaster compared to a data center using surplus hydro or wind power.
I'm not saying gold mining is clean, but the utility of gold in electronics, in aerospace, and as a reserve asset is universally accepted as justifying that cost. Bitcoin's utility is still being debated. And on the regulatory front, gold has no protocol risk. Governments can tax it, sure, but they can't bug it. They can't 51% attack gold. With Bitcoin, you have regulatory choke points at the on-ramps and off-ramps. We are seeing strict AML rules, the travel rule. Governments are tightening the noose.
And yet, despite that tightening, the network keeps producing blocks every 10 minutes. The resilience is the point. The Genius Act here in the US actually clarified the rules, treating it as a commodity. Regulation brings clarity, which brings more capital. But I want to touch on something cultural, the generational divide. You look at the demographics, millennials and Gen Z, they intuitively understand digital scarcity. They live their lives online. To them, gold is an archaic rock. It's illiquid, it's hard to verify. They trust code more than they trust the London Bullion Market Association.
That's true. The demographics favor digital assets right now, but as those investors age, as they accumulate real wealth that they need to preserve rather than grow, the psychology shifts. Gold is for staying rich. Bitcoin is for trying to get rich. And right now, in 2026, with tariffs looming and war drums beating, the world is in stay rich mode.
I disagree. I think the world is in a debasement mode. The US debt is spiraling. Currencies are being weaponized. The younger generation sees that the old financial system, the one built on gold and fiat, is broken. They aren't moving to gold as they get older. They are dragging the financial system toward digital standards. Bitcoin is the exit ramp from a system that dilutes your wealth.
But look at the last month. The system is shaking, and Bitcoin dropped 30%. That is not an exit ramp. That's a trap door. If you bought the inflation hedge narrative in late 2025, you are underwater significantly, while the gold bugs are up 18%. You have to acknowledge that the market is voting with its wallet right now, and the vote is for stability.
The market votes in the short term, but it weighs in the long term. We're in a price discovery phase. When gold was repriced in the 1970s, it had 50% drawdowns too before it went parabolic. Bitcoin is undergoing that same monetization process. The volatility is the admission ticket for the upside. You mentioned the 30% drop. I see a 30% discount on the only asset with a fixed supply cap in the universe.
And I see a speculative asset deflating as liquidity dries up. But perhaps there's a middle ground here. We are treating this as binary. You must hold one or the other. But sophisticated investors rarely think that way.
That's a fair point. We are seeing the emergence of the barbell strategy, or what some call the integrated reserve architecture.
Right. It doesn't have to be a religious war. You can view gold as your defensive anchor, the part of your portfolio that ensures you don't go to zero if the power goes out or the internet fractures.
Exactly. And Bitcoin is the aggressive growth engine. It's the call option on the future of the digital economy. If you're conservative, maybe that looks like 10% gold and 2% Bitcoin. If you're aggressive, maybe it's 5% gold and 15% Bitcoin.
I think that is the practical takeaway for our listeners. It depends entirely on your risk profile. If you are nearing retirement and you can't stomach a 30% drop in a month, Bitcoin's asymmetric upside doesn't matter to you. You need the stability of gold.
But if you're 30 years old, holding a rock that yields 0% and barely beats inflation over the long term is a massive opportunity cost. You need the exposure to the digital network effects. You need to capture the value of the network growing.
So, to wrap this up, we're standing here in January 2026. Gold is at 5,500. Bitcoin is at 83,000. If we look back in 5 years, who wins?
I maintain that Bitcoin recovers from this slump and outperforms. The fundamentals, the hash rate, the user growth, the ETF inflows are all up and to the right. The price is lagging the reality. Bitcoin is simply the superior technology for moving value across space and time.
And I maintain that as long as the world is unstable, gold remains king. The Greenland crisis is just one symptom of a fracturing world. In a fractured world, you want the asset that has no counterparty risk and 5,000 years of trust. Gold is the risk-off king for a reason.
We will have to see how the rest of 2026 plays out. But one thing is certain. The interplay between these two assets is going to define the future of macro investing.
Absolutely. And whether you choose the digital path or the ancient path, make sure you're doing it based on research, not just hype. Talk to your tax advisor, understand the regulations, and know what you own.
Understanding beats speculation every time.
This has been Daily New History. We'll see you in the next one.